Hey everyone, and welcome back to another portfolio update video on the channel. Portfolio is currently sitting at $14,119.57. For the day, we are down 265.25 or 1.84%, down an extra 46.25 overnight or 0.33%. For the week, we are down $345.18 or 2.39%. For the month, we are down 464.05 or 3.18%. For the 3 months, we are up 324.50 for 2.35%. For the year to date, we are up 305.87 or 2.21%. For the 1 year, we are up 5.84% or $779.57. And finally, for the all-time chart, we are up $924.63 or 7.01%. So the market has been taking an absolute beatdown recently, as you can see. At one point recently, we were up 13%, and now we are only up 7%. So we actually got about half of our gains wiped from this recent pullback in the past month or so. So at one point we were at $14,920, and now we're at about $14,200. So pretty crazy shift in the market, honestly. About a $700, $800 move in my portfolio personally, and I think we're moving into correction territory on the Nasdaq as well, which is pretty significant. So let's take a look at our SPY shares here. So we have 26.58 SPY shares with an overall gain of about 410.16 or about 3%, an average cost of 515.82, and yeah, almost 27 shares at this point, which is pretty sweet. Still adding on to that position. And yeah, we also got paid that SPY dividend at the end of the month since it's now August, which was pretty cool. So we got like, I think $38, which I reinvested back into SPY. Um, but yeah, you can see here, SPY took an absolute beating this week. And at one point, we had a really crazy day. SPY was up, I want to say like 2.5% on, I guess, the 31st. And you can see we peaked here at 554, and then now we pulled back all the way $25 lower. And of course, $25 per 26 shares is a pretty extreme pullback. But yeah, so we had a pretty nice rise here. We were almost actually getting back to peak levels at one point, about $10 off here, as you can see, 10 or 11. And then we had this huge fall off, which was pretty crazy. But yeah, so pretty huge pullback is kind of the news for the week. The reason for that, originally we had a really nice run up because jobs report came in, or was it jobs report or inflation? I can't remember what it was. But earlier in the week, or it was the Fed speaking, sorry. Fed spoke and basically said that interest rate cuts are on the table for September's FOMC decision, like very likely, which sent the market pretty high, much higher, and it was pretty exciting for investors in the broader market to hear that because finally we'd have interest rates dropping, making borrowing easier, which makes investing easier. So the whole economy gets stimulated by that. So everyone really liked that. We had this really nice pump here in the middle of the week, which was looking really good in the portfolio. And then I believe it was the jobs report came out the next day at 8:30, and it was looking really bad, like not bad in a way that's I guess good for a sign of rate cuts, but bad in a way that it could threaten the current state of the economy. I believe is what it was, and so this sent a lot of fear into the market of people worrying that the Fed might have waited too long to actually cut the rates. Which led to this huge sell-off because people were fearful, obviously, that, like I said, the Fed waited too long to cut rates, and now something in the economy was going to break before they get a chance to cut rates, and that ultimately we'd go back into a recession, or yeah, we'd go into a recession. Last one being during COVID. So yeah, there's basically recessionary fears are coming back, and in tandem with that, rate cuts coming soon, hopefully. But people are worried it might be too late for that after this most recent economic data report. So that is kind of the state of the market. So originally things were looking good, like, oh, we're going to cut interest rates. Then jobs data came out really sour and sent the market lower, as you can see. So that's where we're sitting at right now. And that's combined with poor corporate earnings or large company corporate earnings in the past week. Or yeah, it was last week I covered that. I believe it was Google was the big one that really kind of messed up. And so it's all that kind of combined, giving a worse outlook on the economy. And so that's what caused this big pullback here. And yeah, so I mean the market's been going up and up and up and up, as you can see. So we're due for a pullback, and we saw this before. So it went from 523 to 495. Let's actually go back and see how recently was that. So up about 10% to yeah, so it's about a 6% pullback. So similar situation here. In fact, we're about at the same correction territory as we had been previously. And then we had this really nice rally. So we'll see what happens. It depends on if the economy can hold up steady. If more economic news or data comes out that looks good for the economy and doesn't look so recessionary and dangerous, then I'm sure we'll see a recovery and people won't be as worried. If data keeps coming out looking super negative and just bolsters recessionary fears, I'm sure we'll see the market go lower. And then, of course, I think it's pretty pretty reasonable to expect a rate cut at September's meeting. So I think that's kind of priced in now. So I don't think that will really save it unless they cut rates significantly more than expected. And I think they're expecting 50 basis points, which is a lot anyways. So I don't know. I think we'll have to just see as economic data comes out. And I mean, we may as well, we can just go ahead and check anyways. Go to Market Watch, economic calendar. It's where I normally go for my the weekly economic news. See what we got here. So coming up, it is August 3rd. So coming up this week, we have doesn't look like anything crazy. Initial jobless claims is kind of big, not really. Next week, let's see, PPI, Producer Price Index, CPI, that's huge. So it looks like this current week that we're going into is not going to be anything crazy. The following week will be really volatile, it looks like, depending on where PPI and CPI come out. If they come out looking like inflation has really been fought off really well, if it drops significantly or below previous lows, then that's what we hope to see, obviously. I guess we'll see. Quickly look up a CPI chart. I don't know if we can how that'll look, but may as well try. Um, okay, yeah. So this looks like what I'm looking for here. I wish I could shrink it, yeah, to like be less than that. Um, but yeah, so I don't think I can zoom in on this really, but yeah, so we've kind of had inflation at a standstill since June. It was at its lowest in June of 2023, and then it's kind of been hovering here, which is not great because the Fed wants to get it down to 2%. But we did see it drop back down to 3% in the most recent CPI report, which is really good because I think that's what kept the market going up like this here. Because I was in early June at some point, I would assume like probably around here, and I'm sure that's what helped boost it up even further. If the CPI report comes in even lower, like if we see a drop into the 2% range, like 2.8, 2.9, I think that would be huge for the economy. I think the market would love to see that. And if we do see that, that kind of guarantees the rate cuts, significant rate cuts, I think, because it kind of shows inflation is done for, which I think will turn people's attention off of the unemployment and have them focus more on the fact that inflation is under control. What you really don't want to see is us still having inflation while having bad unemployment at the same time. So like if CPI jumps up, that could be really bad. But once again, that's next week, so we got some time to think on that. But yeah, so that's kind of how the market's looking right now, at least from my perspective. Um, One other thing I wanted to talk about is I am thinking of moving some of my portfolio into allocating into bonds, corporate bonds, government bonds, and then short-term treasuries. And the reason for that is I'm reading a book called The Intelligent Investor by Benjamin Graham currently, and he has really given me some interesting insight and perspective onto the history of the stock market and also onto proper diversification and risk management for long-term investing. And while I do think SPY is great, of course, I do think it does still carry some risk. Everything does, of course, but being purely SPY is still partially risky. Um, and not, I mean, this book is kind of giving me that perspective that I needed to sort of see that. Not that SPY isn't a great long-term hold. I could probably hold on to this, never sell it, and turn out just fine. But I do think it is interesting the insights he poses and all of that. So I am thinking of allocating something small, probably like 10% of my portfolio to bonds, just to kind of at least get some educational experience on bonds and sort of figure out, because it would be a good tool to understand for the future, maybe 10, 20%. So I'm going to look into doing that probably in this coming week as well. I'm looking at a couple different bond ETFs, and of course, you'll see that in the next video. I'll let you know. But that's what I'm looking to do, just to diversify a little bit. Of course, I'm super young, so my time horizon is really far out. So I really don't have to worry as much about risk and whatever. But It is still interesting. So yeah, looking into doing that. So in case you see that in the next video, that is the reason for that. But yeah, other than that, I think that's just about everything. Thank you for watching this video, and I'll see you in the next one. Goodbye.